If you want to act powerfully in the financial market, it's essential to understand several simple yet critical aspects of trading. Spread, swap, and commission are among the terms used to describe trading costs in the Forex market. In the thriving world of Forex, understanding trading costs is crucial for any trader. Three key terms you need to know in this context are spread, swap, and commission. In this video, we will explain these concepts in detail and discuss the reasons behind each of them in the Forex financial market. This information will help you make informed decisions regarding broker selection and effective management of trading costs. What is spread? The spread is essentially the difference between the buying price, bid, and the selling price, ask, of a currency pair. For example, if the buying price of a currency pair is 1.1200, and the selling price is 1.1202, the spread would equal 0.0002 or 2 pips. Why does the spread exist? The spread serves as one of the sources of income for brokers. Additionally, the spread is created due to market volatility, and the costs associated with executing transactions. Types of spreads. The spread can vary based on the type of trading account you choose and may fall into one of the following categories. Fixed spread. The spread remains constant during all trading hours. Variable spread. The spread changes based on market conditions and may increase during times of high volatility. What is a swap? A swap is the cost associated with holding an open trading position overnight. This cost arises due to the difference in interest rates between the two currencies that make up a currency pair. Why does a swap exist? A swap is created to compensate for the broker's financial costs as well as to create balance in the market. Types of swap. Positive swap. If the interest rate of the base currency is higher than that of the quote currency, it is a positive swap and will be credited to your account. Negative swap. If the interest rate of the base currency is lower than that of the quote currency, it is a negative swap and will be deducted from your account. What is a commission? A commission is a fee that some brokers charge their clients for each trade. This fee is usually calculated as a percentage of the trade volume or as a fixed amount. Commission acts as another source of revenue for brokers, and is used to cover their operational costs. In some trading accounts, it is accounted for to reduce the spread. For example, in accounts like ECN Pro. Understanding the importance of spread, swap, and commission is crucial for success in Forex. These costs directly impact your trading profits and losses. By choosing a broker that offers reasonable spread, swap, and commission fees, you can reduce your trading costs and increase your chances of success. Tips for reducing trading risk and increasing profit before starting Forex trading. Comparison of brokers. Before choosing a broker, make sure to compare the spreads, swaps, and commissions of different brokers. Trade volume. Your trade volume will affect your final costs. The larger your trade volume, the more significant the importance of commissions will be. Type of trading strategy. The type of trading strategy you use will also influence the importance of spread and swap. Spread, swap, and commission are three main trading costs in Forex. Understanding these concepts will help you choose the right broker and manage your trading expenses. By choosing a broker with lower trading costs, you can increase your chances of success in the Forex market. If you have any questions about spread, swap, commission, or any terms and techniques, you can ask our experts. Also, to stay updated on the latest market trades and educational videos, subscribe to our channel.